So it's my pleasure to introduce this year's Felix Neubergh Lecture, and this is an annual event held at the university since 1977. In the Econ department, it's a biannual event because it's also a biannual event in the archaeology department, apparently. Hélène Rey is a professor of economics at the London Business School, and I think sometimes when you introduce a speaker, it's hard to put a label on what their research field is. I think in Helen's case, it's quite easy, actually. She does international finance, and I don't feel too uncomfortable labeling her as such. She has done made very important contributions in various areas, and especially on capital flows and the external balance sheet. She has written some very influential work. And among other things, she has worked quite extensively on the exorbitant privilege enjoyed by the US as this key player in the international financial system, which has also looked at things like PPP and the importance of using disaggregated data. She has made contributions to the big question of home bias in equity holdings. And she's also studied the link between exchange rates and capital flows and equity prices, which I myself found very interesting. I actually tried to enjoy and invite Helen to a seminar many years ago when I was a new economist at the Fed. Back then, she told me that she had just had a kid and didn't travel so much this term. I probably thought that was a rather bad excuse at the time. Now I have 2 kids, and I know it was probably genuine. But since I finally have her here with the named lecture and everything, I'm very happy to turn over the floor to her.
Thank you very much for this kind introduction. So today's talk is about capital flows, exchange rate, and the international monetary system, which is more or less everything I've been working on since I started. And I'm going to base this lecture on a series of papers I've done in the last years with a number of co-authors. So if after the lecture you're still interested in the topic, if any of you is still interested in the topic, please, all the material I'm going to refer to is drawn from working papers or papers which are on my website. Now, why has the international monetary system become fashionable in some sense again? People in the G20 talk about the international monetary system. Policymakers have been worried about it in the past years. So there is a lot of debate about whether we have a functioning international monetary system or not. And I think a lot of the interest that has gone back to these issues comes from this type of graph here that you can see. So what do I have here? I have a graph of what has been called the global imbalances. This is a graph of a current account deficit or surpluses. If it's positive, it's a surplus. If it's negative, it's a deficit of a number of countries. And what are current accounts? Well, current accounts are just a measure of international borrowing and international lending. So if a country has a current account surplus, it means the country is lending. If a country has a current account deficit, it means this country is borrowing. And what has happened in the world economy since the 80s, and in particular since the 90s, and here the 2000s are kind of an extreme case, is that we have seen a very wide divergence in the pattern of current account deficits and current account surpluses across important economies. In particular, you can see these large bars here, which are the United States current account deficits. This is expressed on the vertical axis in terms of world GDP. So we are talking large numbers, because world GDP is a large number. And you see that there has been very sustained, persistent, large deficits of a current account in the United States. So the United States has been borrowing a lot. On the other side, someone else is lending, obviously. So who has been lending? Well, almost everyone else. In particular, Japan has been a large lender, but also oil producers have been very important lenders. And more recently, we have seen a growing role for China as a lender to the United States. So you see that this pattern of current account deficits and surpluses have been really widening, in particular after the Asian crisis here, which has been a kind of trigger point for the accumulation of a large amount of reserves, in particular in Asian economies. So a lot of Asian economies have started to accumulate a lot of US government bonds, in particular, and safe assets to protect themselves against crisis, and therefore they have been lending a lot of money, in particular, to the United States. So this is a very striking pattern in international finance, that we see so large imbalances in terms of borrowing and lending across countries. Now, together with the international borrowing and lending, which occurs every year, if you keep on borrowing, like the United States, you accumulate stocks of liabilities. If you keep on lending, you accumulate stock of assets. Okay, so assets are just accumulation of the lending that you do. You accumulate assets on the rest of the world. And liabilities, the stocks of liabilities, is just the accumulation of the borrowing that you do over time. Right? So this is, when we talk about current accounts, this is a flow, which goes, it's measured during a certain period, how much I borrow during a certain period. And when we think about accumulating over time our borrowing and our lending, we talk about our stock of foreign assets or our stock of foreign liabilities. And therefore, the net foreign asset position of a country is going to be defined as the difference between the stock of assets that I accumulate over time minus the stock of liabilities. Okay, so that's the net foreign asset position. What I have here is the gross cross-border assets and liabilities. So this is not the net. This is the sum of the stock of assets and the stock of liabilities that countries of the G7, the blue line, or of main emerging markets have been accumulating over time. And what this graph is trying to show is that we have had a lot of financial globalization. So these flows that we have been discussing, with current account deficits and surpluses, what they have turned into is growing stock of foreign assets and foreign liabilities, in particular for advanced economies. So the G7 economies have been accumulating assets and liabilities cross-border in an unprecedented fashion. Okay, so that's what we call financial globalization. That means there's a lot more cross-holding of assets across countries than we used to have. And that's something that is going to be quite important at different levels, and I will certainly come back to that. So financial globalization has been really increasing in the 90s, as you can see here. It has been mostly so far an advanced economy phenomenon. If you look at the BRICS, Brazil, India, Russia, China, they are lagging behind in terms of the stocks of assets and liabilities that they own or that they owe internationally. Though you see that the trend is also increasing there, but it's not nearly as much as for the advanced economies. So financial globalization has increased a lot in the 1990s, and mostly in volume, that's mostly an advanced country phenomenon, but it's picking up to some extent also for emerging markets. Now that I set the stage for this increase in financial globalization and these global imbalances, so I'd like to come to the issues of the international monetary system and how it operates. So what is the international monetary system? So at a basic level, it's defined as a set of conventions and institutions that govern the conduct of monetary policies, their coordination, the exchange rate regime, and the provision of international liquidity. Now, until 71-73, we had the Bretton Woods systems, which was a system by which the dollar was the center country of the system, was convertible into gold at a fixed rate, and most of the currencies were pegged to the dollar, and hence, by transitivity, they were also convertible into gold at a fixed rate. So that was the Bretton Woods system. The US was at the center of it. The dollar was at the center of it. The dollar was as good as gold at a fixed rate, and everybody was pegging to the dollar. That was Bretton Woods. After 71-73, we saw the collapse of the Bretton Woods system, and we have been to a system of flexible exchange rates. That is to say, the value of currencies has been allowed to fluctuate. It's not anymore fixed vis-à-vis the dollar, not anymore fixed vis-à-vis gold. And everybody is moving up and down. So you don't have a fixed amount of gold anymore for your dollars. You don't have a fixed amount of dollar for your euros, etc., etc. This is the system of flexible exchange rate. And this is the system we have been living in. Now, I say the system, but this is pretty much a non-system in the sense that there are no very clear rules in that system. Some currencies are fully flexible, fully floating vis-à-vis other currencies. Other currencies are pegged. They can be pegged hardly. They can be managed floats. So there are lots of different possibilities within this system. We mostly have current account convertibility, meaning that if we want to do international transactions for trade in goods and services, usually there's not much restrictions. But on the financial account side, investment in some types of assets that may be restricted in some countries. So there's no full financial account convertibility, it's incomplete. And what we see is some countries have chosen to let their currency float to insulate themselves from external shocks. But other countries which theoretically have chosen a free floating exchange rate sometimes revert to a managed float when there are big shocks. Think of Switzerland recently, which have limited the fluctuation of its currencies because it was appreciating too much. Think of a number of Latin American economies who have been doing that as well. Think of China, who has never so far opted for a freely floating currency with a very managed currency still. So we have a lot of different systems effectively within the post-Bretton Woods period where we are. However, what has stayed constant in some sense is the importance of the dollar as the main currency of the international monetary system. This is something that, to some extent, has been inherited from the past, but is also, of course, very much linked to the large dominant position of the US economy in the world economy. So the dollar is, by any measure, I will show you some measures, still the dominant international currency today. So what is an international currency exactly? What's that? Well, just like a currency, an international currency has the three main functions of a currency, which is medium of exchange, store of value, and unit of account. A currency is a medium of exchange. That's maybe the most fundamental function of currencies. We use currencies to trade. As any medium of exchange, a currency will be most useful if a lot of other people use it to trade. So we all speak English more or less because everyone speaks English. So that's convenient. A lot of people use the dollar to trade. Therefore, it's very useful as a medium of exchange. It is immediate when you think about it that if a currency establishes itself as a main medium of exchange, it's going to be a very persistent position. Because once a currency is used by a lot of other people, there is a network effect. There is very little incentive for some people to go out of a network. It's not efficient at all. If you try to transact in a currency no one else uses, you are going to pay a lot of transaction costs. So once you establish yourself as a main international currency, it's going to be a very persistent state of affairs. This is why, over time, we haven't seen that many important international currencies. Before the United States became the country at the center of the international monetary system, the sterling was the main international currency, and it got displaced very, very slowly as the importance of Great Britain declined in the world economy. It got displaced very, very slowly by the dollar. But the sterling remained a very important international currency for a long time after the economic significance of the UK after the economic significance of the UK was put in question by the supremacy of the, in particular on the trade side of the United States. So that's the medium of exchange. Now, you have also the other function of a currency, store of value. Of course, if you have something that depreciates very quickly, a lot of inflation, it's not going to be an international currency very long. Nobody is going to use it. Okay, so it goes together, the store of value function, to some extent with the medium of exchange. And the unit of account function, that would be, for example, a number of countries pegging to the dollar rather than pegging to the Japanese yen. So that would be an example of the use of the dollar as a unit of account. If we look at the share of the dollar, compare here to the euro, on the international scene, so this is what you see in this table, you see that overwhelmingly, and whether you look at it at the end of the 90s or the end of 2000s, overwhelmingly, the share of the dollar in all the aspects that I described is way higher than the second international currency, which would be the euro. So if we look, for example, at the share, the stock of global foreign exchange reserves, you see that the position of the dollar is quite dominant. Above 60%, less than 30% for the euro. If we look at the share of foreign exchange turnover, out of 200% turnover, because it's a bilateral transaction, you see that overwhelmingly the dollar is dominant, 90%, 80% here. So there is a lot. If you look if you looked at the number of countries pegging, again, there's a lot more in dollar, etc., etc. So by any measure you're going to take in the international currency world, the dollar is the dominant international currency. And these measures have not been affected much, as far as I can tell, so far, by the crisis. Now, so why is it so? So what is the international currency role of a dollar doing? Well, one very important aspect of this international currency role of the dollar, as we have seen, is the role of reserve currency and of liquidity provider, in particular, in time of crisis. So the dollar being the most liquid international asset, it's naturally the asset that people want to hold in a crisis. It's the asset they want to hold reserves in, so that they can actually use it if things go badly. So this is going to be one asset that people very naturally accumulate as reserves. So the United States issues a lot of treasury bills and government bonds, which are very liquid, hence can have relatively low yields. And that's going to be on the liability side of the US. The US issues a lot of this type of assets. So that's going to be assets that the rest of the world buy from the United States. And conversely, what is the US going to buy in return? So what kind of assets will the US hold? Well, the US will tend to hold riskier assets, equities, foreign direct investments. So US investors will tend to buy, for example, FDI in China. They will tend to buy equity in Japan. And that's going to be the asset side of their external balance sheet. And on the liability side, that's the government bonds, etc., the T-bills, etc. So the external balance sheet of the US, the external assets, external liabilities, has a very asymmetric structure. There are very different types of instruments on the asset side and on the liability side. And I'm going to show you the external balance sheet of the United States. So this is based on work that I've done for a very long time, which involves putting together a number of data sources that are of different types on stocks and flows, on valuations, in order to get the time series of the external asset position, gross, and I will show you the external liability position, gross as well, of the United States, from the 1950s, 1952 exactly, until as recently as we can. Now, this asset side is divided in different categories of instruments, financial instruments, and they are all reported at market value. So all the numbers you see here, these kind of relatively volatile lines, it's because all the assets for this graph are reported at market value. So it's important, it's an important distinction. When you look at the time evolution of the external balance sheet of a country, of the external position, assets or liabilities, it changes because of two things. It changes because of flow. You either borrow or you lend. So there's a flow that's going to accumulate or decumulate. But it also changes because the value of the instruments that you have is changing over time. Equity prices move up and down, but also the exchange rates move up and down. So the value of your net external asset position is very much dependent on valuation of asset prices. And until relatively recently, there was no data of the net external asset positions or the gross positions at market value for this extended period of time. So we built this time series, and now let me tell you what we see with it. So here what I have are the broad categories of a balance of payments. So on the asset side, you have equity, that's going to be the purple bit here. You have foreign direct investment, that's the green bit. You have debt, and this is together corporate debt and government debt. You have here mostly, this is bank loans, and this is also trade credit. Okay, so this is bank loan and trade credit, and this is gold. So what you immediately see is that there has been a massive increase in the 1990s on the stock of cross-border assets. This goes together with what we have already seen. There's been a massive amount of financial globalization. That's the first order effect. What you also see is that on the asset side of the United States, there's quite a bit of this risky asset. There's quite a bit of equity, foreign direct investment. There is very little of debt on the asset side. The red thing here is small, relatively, compared to equity and FDI. And you have a fair amount of bank loans and trade credit. So that's what it looks like. And you see everything is expressed in percentage of US output. So these are relatively large amounts. OK, so now let's keep that in mind, and let's have a look at the liability side. The liability side looks different. First of all, so it's also growing very fast in the 1990s. It goes even higher than the asset side. The US is a net debtor. Okay, its liabilities externally are bigger than its assets. But the composition of this thing is very different. So why is it different? So if we look at the debt component, which here we can disaggregate between corporate debt and government debt, you see that if you sum up these two components here, it's a large bit on the liability side. It's way larger than this little red thing that we had here, which was debt, total debt. So there is a lot more debt on the liability side than there is on the asset side, clearly. And comparatively, so there is a lot less foreign direct investment and equity than there was on the asset side. So if I sum up, if we look at the asset side of the US, there is quite a bit of foreign direct investment and equity investment. So for example, US investor holding Hong Kong equity, there's quite a bit of that. However, on the liability side, there is a lot of US government bonds which are issued and bought by the rest of the world. Okay, so there is a very asymmetric structure of the US external balance sheet by type of instruments. If you look at the currency composition of liabilities and assets, it's also very asymmetric. Most of the liabilities, more than 90%, are actually in dollar. Okay, so the US issues debt, it's in dollar. On the asset side, there's a lot more in foreign currency. 2/3, approximately, of the external assets of the US are in foreign currency. So that's an interesting balance sheet because it tells you that, for example, when when the US dollar depreciates, this actually has a positive effect on the net foreign wealth of the United States. Why? Because if the dollar goes down, the liabilities are in dollars, so they are in dollar, fine. What happens to the assets? Well, the dollar goes down relative to the euro or to the yen or whatever, or to the Swedish krona. If this is the case, then the dollar value of all these assets which are in foreign currency goes up. You get more dollars for given kronas, for given euros, for given yen. So when the dollar goes down, the net foreign asset position of the US improves. And this has a stabilizing effect. This is very different from a typical emerging market external balance sheet, where, for example, take the Asian crisis of 97-98, you had a lot of borrowing which was done in foreign currency. And when the domestic currency depreciated, this was exactly the same mechanism playing in reverse. You had all the balance sheets of Thailand, Indonesia, South Korea being completely squeezed because the dollar appreciating compared to the domestic currency, that meant the value of the debt shot up compared to the assets. And this was one of the reasons why the Asian crisis was so difficult to deal with. That was this currency mismatch, which went the wrong way in crisis time. So we see it's very different from the US case, which has this stabilizing effect. All right. So another consequence of this asymmetric balance sheet is that the US, to some extent, looks like a world banker. So why is that? It's because a banker is someone who lends long and borrows short term. So you issue liquid liabilities, and you invest in risky projects which earn a higher return. That's what bankers do. You bring money that's deposits. You are not paid much on your deposits, if at all. It's very liquid. You can take them away if you like. And then the banker invests in more illiquid projects which have a higher return. That's what banks do. Well, if you think about the United States, it has this flavor, this balance sheet, right? Because it issues all these safe, liquid debt that the rest of the world is willing to buy. Okay, so the rest of the world is willing to lend this liquid stuff. And then the US invests in foreign direct investments. It buys companies in China. It buys companies in the UK, in Ireland, etc. Or it buys equities. And this is what it has on its asset side. This is what we have just seen. So it acts like a banker, a world banker, effectively. And therefore, as a world banker, or as a banker, it should have a positive excess return on its assets compared to its liabilities. It should make money out of this job, out of this pattern of borrowing and lending. So what we did in some work is that we computed the excess return that the US earns on its assets compared to the return it pays on its liabilities. And we called that, because in that case, I was with a French co-author as well, we called that the exorbitant privilege as a reference to the exorbitant privilege mentioned by Valéry Giscard d'Estaing, who was the finance minister of de Gaulle in the 1960s, who was always complaining that the US had some kind of advantage due to its role in the international monetary system. So we define more narrowly the exorbitant privilege of the United States as the excess return it earns on its external assets compared to its external liabilities. Now, this is just a table. I will show you some estimates of the excess return. So this is just a table to convince you again that there is this asymmetric structure of the US external balance sheet if we look at the gross liability side versus the gross asset side. So we see that on the liability side, there are all these debt here, government and corporate, etc. On the asset side, there's more equity and investment. And so if we do a ratio, both in 1971, which is at the end of Bretton Woods, And just before the crisis here, which is at the end of 2007, if we look at the ratio of what we call safe and liquid liabilities divided by total liabilities, we find it's about 2/3, a bit more than 60%. And if we look at risky and illiquid assets as a share of assets, we find it's, again, very high. And the two amounts are relatively similar at the end of Bretton Woods and now. OK, so now let's go back to the computation of, or the estimations of this exorbitant privilege. In order to compute that, it's not so easy, because as I mentioned, to get these external assets and liabilities at market value, you have to do quite a bit of data work using these different data sources. So you have to make some assumptions at some points when you build the data. And so we have done a lot of robustness checks on how we construct these things, etc. And we have different estimates of the excess return. So here we have them on the 1952 till 2010 period. I now have also an extension till 2012. The bottom line is that if you look at this extended period, you find an excess return on asset minus return on liability, which is about between 1.8 and 3 would be some type of ballpark you find. So this is not negligible at all. If you cut the sample shorter, you tend to find, so the post-Bretton Woods sample, you tend to find higher excess returns. Now, these are constructed under different assumptions. Maybe the most reasonable set of assumptions is what I call here mixed. And here you see that, so you find 2.4 excess return on the whole period. You find about 3 on the post-Bretton Woods periods. So these are relatively significant excess return due to this asymmetric structure of the external balance sheet of the United States. Now, so we understand the United States is special in the international monetary system. So what do the other countries look like from the point of view of its external balance sheet structure? What can we say about them? So the data are usually not as detailed as in the US. So it's not the case that for any country, I could show you the same graph that I showed you for the US, unfortunately, because we wouldn't have enough data to construct that. So what we have, however, is more coarse data and also annual data instead of quarterly data. And there what you usually find is that the type of structure that the US has, the US is an extreme case of being really on the risky asset side and safe liability side. But usually advanced economies tend to be reasonably long in risky assets, so have quite a lot of equity and foreign direct investment on the asset side. So they buy companies, they buy equities abroad, and et cetera, et cetera. On the other hand, emerging markets are on the other side. So emerging markets are the ones who sell companies, who sell equity, et cetera. So they are short risky assets. And this is what you see here on this graph. If you look at the G7, so the advanced economies, you see that this is the risky assets minus the risky liabilities. You see this is positive, so that means they buy more companies and equities than what they sell to the rest of the world. On the other hand, the emerging markets, they do exactly the opposite. So they sell a lot more of their companies and of their equities to the rest of the world than what they buy from the US or from Europe, et cetera, et cetera. As you will see, this means very different things to what happened to their net external position, to their net wealth, external wealth, during crisis. And I'll come back to that. So, but it's a very strikingly asymmetric feature of external balance sheets if you compare advanced economies to emerging markets. Now, here is the famous US net foreign asset position. So I showed you the gross assets, the gross liabilities. These were stocks, okay, on both sides. And now I'm showing you the difference, that is to say the net position. Gross assets minus gross liabilities, that's the net position. And this is where we see that the US, you see it's, so this is this line, my net foreign asset position at market value here. You see that it's negative since the 80s sometimes. So the US is a net debtor, okay? And this is at market value. Interestingly, you see that red line. This is what you would obtain if you would not take into account the valuation of asset prices. If you were just cumulating those current account deficit that I showed you in the first graph, if you were just doing that without taking into account exchange rate fluctuations, equity price fluctuations, etc., you would get this thing here. And you see that you would greatly underestimate the net foreign asset position of the US. So it means the US is doing a lot better in some sense than what it looks like when you simply look at the current account deficits, because it has these positive valuation gains on its net foreign asset position. It has these excess returns. So it shows, and it's a lot. Okay, so that's what we find for the United States. Interestingly, if we do a similar exercise for the UK, and everything is less precise than for the US. So the US numbers are the most precise one. For all the other countries, it's going to be less precise, what I show you, just because of data. So for the UK, you see here that, again, if you look at the net foreign asset position, the UK became a net debtor, sometime at the end of the 80s. And roughly, so if you take the accumulation of the current account, so you miss a lot of turning points, you miss a lot of things, and still you're going to look worse than if you take the net foreign asset position, taking into account the valuation gain. So the UK is also, on balance here in the recent years, having some valuation gains, so that its net foreign asset position is not as bad as what it looked if you were just accumulating the current account. These data are basically taken from Philip Lane and Gianmaria Milesi Ferretti data sets, which is a cross-country data sets, which is a very nice data sets. They do the best that they can do given the data limitation. Now, if you look at Germany, interestingly, so you see here we have a creditor country. It's having current account surpluses, so it's accumulating assets, so we're on the positive side. And here what we see is that in the recent years, actually, there are more valuation losses than gain. So at market value, actually your net foreign asset position of Germany is smaller than if you were just to accumulate the surpluses. So that means Germany has been making losses rather than gain on its external position in the recent years. A more extreme case of that, subject to data quality, which becomes more and more problematic as we go along here, is China. So China, as we know, has been accumulating recently, but very quickly, a lot of net foreign assets, a lot of it being in reserves. 3 trillion, more than 3 trillion as we speak, in reserve at the People's Bank of China. Now, however, if you looked simply at the accumulation of reserves, you would overestimate the net foreign asset position because China has been making some losses on this, on its investments. If you look at Russia, this looks even more problematic. And indeed, so here I would, there would be probably reasons to believe that very significant problems of reporting, I would think, also in this data. But if you take them at face value, so what it says is that, again, the valuations have been quite negative. And if you were simply to accumulate the surpluses, you would greatly overestimate the Russian external position. Now, so I'm hoping so I convinced you that there's a great deal of asymmetry now in the external position of countries, and there's a great deal of asymmetries on the balance sheet themselves between assets and liabilities, and this asymmetry is very heterogeneous, depending whether you have a US, an advanced economy, or emerging markets. So this means that the type of adjustments that countries undergo during crisis or when they have significant imbalances is very different. So for the US, as we have seen, a dollar depreciation is stabilizing. For an emerging market, especially in the past, it was very destabilizing to have a currency depreciation. It was really squeezing the balance sheets. So a very, very asymmetric response. responses. In the case of the US has an excess return on its position, so it helps from the point of view of a sustainability of external deficits. The US doesn't need to export as much as you would think it does in order to repay its external debt, simply because it makes these valuation gains, on average, on its external asset position. So some of its deficits can be repaid by this, call it exorbitant privilege. So to some extent, the center country faces this relaxed budget constraint. Now, in crisis time, there are issues with adjustments in general in the international monetary system. And these are long-standing issues that go back to the old debate between Keynes and White at the time of Bretton Woods. And it's because there is this fundamental asymmetry, which is that usually if you have a country, and especially an emerging market, so let's not talk here about the US, but let's talk of all the emerging markets that you can think about in Latin America, in Asia, etc. If these countries have deficits for many years, external deficits for many years, well, at some point, foreign investors stop investing. These countries lose credibility. The foreign investors start to think a country which has had 5% current account deficit for the last 5 years will never be able to export its way out of that, will never be able to repay. So I stop investing, and you have usually a crisis, a sudden stop in capital flows, and they can be very devastating for these emerging markets. So usually a deficit country, that is to say a country which runs a lot of deficit persistently, will be forced to adjust simply because people won't lend to that country anymore. Okay, so there's a forced adjustment, which can be painful, but there's a forced adjustment on deficit country. Now think of a surplus country, which is the other side of the same issue, right? If some countries are persistently in deficit, well, depending on the distribution, but it's likely that someone else is going to be persistently in surplus. Likely. Nothing usually forces countries in surplus to adjust. If you run a current account surplus, people are not going to stop, doing business with you. So this can go on. But this can be problematic, especially in the situation we are in right now, especially when you are in a situation where a lot of countries are in a liquidity trap, which means monetary policy is not maybe super effective. Interest rates are at 0, so you cannot go down farther. So adjustment by having more relaxed monetary policy in the countries in crisis is very difficult. Aggregate demand does not pick up. And the way to rebalance the system would have to have surplus country importing more, so that they can actually buy more of the goods of the countries in crisis, the countries which are in deficit. They need more demand for their goods. So they need the surplus countries to actually decrease their surplus and import more. That's what is needed in such a world. And it's especially needed in a world where monetary policy, the world we are right now, that's the channel of adjustment, the usual channel of adjustment with aggregate demand is not operating very well. You need this rebalancing. But nothing can force surplus country to do this rebalancing, unless you put it in a rule. But you have to create. And this was the big debate between Keynes and White, where Keynes was very concerned about this problem of adjustment, asymmetric adjustment. But in the end, it didn't manage to have a very implementable way of dealing with it. So it didn't manage to have a rule that would force surplus countries to adjust and that would be actually effectively used. Now, this was in the Bretton Woods time. We can transpose, but I won't do it, but we can transpose into today's, in particular, euro area crisis. You can think for yourself surplus deficit countries and liquidity trap and what that would mean. And indeed, so we have to be able somehow to engineer a rebalancing at this point within the euro area. Okay. Now, as a result of this asymmetric issue between countries, deficit countries forced to adjust, sometimes very painfully, so emerging markets have reacted to this problem of sudden stops, to this problem of capital flows drying up from one day to the next and putting their economies in shambles. So how did they react? They react by accumulating more precautionary savings. That is to say, they accumulated more reserves. If you face the problem that international investors can withdraw their money very quickly from your economy and can send your exchange rate down very quickly, and you want to counteract that, one way you can do it is by stockpiling a huge amount of dollars, say, and intervene to support your currency, intervene to support your banks if necessary, using hard currency, etc., etc. So as a result of this problem of adjustment in the international monetary system, self-insurance, so accumulation of reserves and precautionary savings, has been increasing. And this is pretty much the another way at looking at the imbalances that we have already seen in many, many different graphs. This is here the accumulation of global reserves since the end of the 1990s, so after the Asian crisis. And you see that reserve accumulation has picked up in many countries, and here it's by different currencies, the US dollar being the most important reserve currency, of course, as we know. But what is impressive here is the speed and the kind of inflation point, the speed at which reserves, global reserves, have been accumulated in order to deal with this problem of adjustment of emerging markets, these problems of sudden stops. Now, at the same time as these reserves have been accumulating, what we have seen is a trend decline in the world rate of interest. So however you measure it, so that the world short real world of interest, here this would be inflation index bonds, you see that there is a trend which points towards a decrease in real rate on an extended period of time. So one interpretation, I'm not saying it's necessarily the right one or the only one, but one interpretation is that this increase in demand for safe assets, this increase in demand for reserve assets that we have seen in the previous slides, has led to an increase in the price of bonds, that is to say a decrease in the real interest rate on this extended period of time. So this demand for precautionary savings, this demand for being insured in case of crisis, is putting some pressure up on the price of bonds, and hence is leading to this trend decline in the world rate. That's one interpretation. It's not the only interpretation possible, but that's one possible interpretation of this, of what is happening here. Well, is that problematic? Well, if we go with that interpretation, so that could be problematic indeed to have this trend decline in world rate. Because if we have a very low real rate, well, first of all, that means the world economy is always very close to a liquidity trap once we are at very, very low levels of interest rates. And we don't know very well how to deal with monetary policy in the liquidity trap, or we don't know how effective, exactly effective this is, quantitative easing, etc. And on top of it, there are some reasons to believe, even though, again, here there's not a consensus, but there are reasons to believe that long-term real interest rate or interest rates which are low for a very long time may lead the financial sector to take excessive risk. There's search for yields. There's all kind of financial innovation aimed at getting some yields in this environment of very low rates. There's a lot of liquidity. There's a lot of money that wants to find some yield somewhere. It's very hard to find, so there's a lot of financial engineering. And one interpretation of what we have seen between 2004, 2005, 2006, up to the big crisis is indeed this emergence of a lot of assets which look safe, which are quasi-safe assets, which are engineered by the private sector, but which yield a tiny bit more than the government securities, because there's a risk somewhere, there's a tail risk, but it's very well hidden. And so financial intermediaries loaded up on these things, took a little bit of extra spread, but loaded on the tail risk, leveraged huge amounts, and then we had the big explosion that we all know. So there is an argument that says that low interest rates can encourage a lot of leverage, and the emergence of all kinds of distortions on financial markets, which usually end up very badly, especially if a lot of actors are very, very leveraged. Okay, so this matters. I mean, I think however way you look at it, this probably matters, what is going on in the international distribution of external balance sheet, the accumulation of reserves, etc. Now, one question we can ask is, okay, so how well did this international monetary system, which looks quite imperfect now that we look at it a little bit in detail, what happened during the crisis? So how did it do? Well, so during the crisis, at the beginning, it really looked like the Great Depression of 1929. If you go back to the 2008 data and you compare it to the 1929 data, you compare the trade, you compare the industrial production, you compare the equity prices, it looked very similar. So it was all going down at the same type of speed or even actually quicker this time around. But then there was a big difference, which was the type of policy reactions that we had, fortunately. So there was a lot more energetic monetary policy reactions and fiscal policy reactions than back in the 30s. And fortunately, I think that's what explains why, in the end, at least so far, we haven't gone to a 1930s style of depression, but we talk about a Great Recession rather than a Great Depression. Now, during this period, there was quite a bit of action in terms of liquidity provision internationally during this big shock of 2008, 2009. And in particular, what happened is that there was an increase in IMS resources that were decided by the G20. There was also a big network of central bank swap lines that was put in place to distribute dollars. So there was dollar liquidity was missing. Everybody was scrambling for dollar because, as we discussed before, dollar is a safe asset. So there was a big flight to safety into dollars, but everybody needed dollar liquidity. Nobody wanted to lend anything risky. Everybody wanted to have, was worried about shocks and liquidity shocks all over the place, so people wanted dollar. The banking system in Europe in particular had a mismatch, not in terms of currency, but in terms of maturity between dollar assets and liabilities, so that it actually needed dollar in the short run in order to refinance dollar assets, which were longer terms. And the foreign exchange market was not functioning. So there was this big scramble for dollars on foreign exchange markets. The swap markets were not functioning, et cetera, et cetera. And so this had to be provided directly via these swap lines between central banks. So the Fed did a lot of swap lines with various central banks to provide dollars. So you see there was an activation of this network of swap line between all the various central banks on the Earth. This was a kind of a complicated network structure, but it worked. And there was about, at the peak, there was more than $300 billion which were swapped in order to provide liquidity during the crisis. Now, so these swap lines worked. But it was a bit of an ad hoc reaction, as you can tell. I mean, there was this network, it was activated. The Fed, was willing and able to do it at short notice. But okay, this was a bit of an ad hoc thing, but it worked fine, and it really helped a lot. Now, another thing happened during the crisis, which is quite interesting, which is that the US, if you look at what happened to its external wealth, the US suffered a big loss in its net external wealth during the crisis. So now that may seem a little bit counterintuitive, because after all, also the crisis started in the US. So a lot of assets which were issued in the US lost value, etc. But The net external wealth of the US also went down pretty significantly. And if you think about it 2 seconds, it's not so counterintuitive what happened, because you have to think of the structure of the external balance sheet of the United States. On the asset side, a lot of risky assets. In the crisis, everything that is risky goes down through the floor, everywhere in the world. Whether it is, Japanese equity, Euro equity, UK equity, everything goes down. So the asset side plunges. The liability side, well, the liability side, the US is the only country that issues the reserve currency, the main reserve currency. By definition, in crisis time, that's flight to quality, people hold the reserve currency. This is the only thing. This is the thing that is the most stable. This is the thing that is worth more in crisis time. So on the liability side, the liability of the US go up or don't go down. They are big. It's mostly the reserve currency. The asset sides collapse. Therefore, your asset side collapse, the liability goes up. That means you have a negative shock on your net foreign asset position. You transfer wealth from the US to the rest of the world. So in other words, during the crisis, the US has provided insurance to the rest of the world, and this is what the center country of the international monetary system should do. This is what a reserve currency issuer does effectively. The liability stays up, the assets collapse, that's a wealth transfer to the rest of the world, that's insurance. So this is what we call in a paper the exorbitant duty, which is the reverse side of the exorbitant privilege. The exorbitant privilege is that people pay you this insurance premium. During good times, you have this excess return on your assets compared to your liabilities. That goes with your balance sheet structure. In bad times, you make the insurance transfer. So you insure the rest of the world. So this is the duty coming with the privilege. All right, so how much was it? Well, we look here at the peak of the financial crisis and 2007 towards beginning of 2009. That was the peak of the financial crisis. What we see is that during that time, the net foreign asset position of the US deteriorated by about 3 trillion. That's a large number. Out of which, the valuation change, so the change in the value of the assets and the liabilities, is about a bit more than 2 trillion. And you see how it happens. Everything goes down. You see these changes in prices. Everything is negative except, look at the government here. Okay, the government debt, that's the US T-bill, the US bonds. That's the true safe asset. That's the thing that really is the reserve asset. So this is what did not go down. Everything else went down except gold. Therefore, this is on your liability. It goes up in value. Everything else in net goes down, and especially your assets go down. Therefore, you make this insurance transfer. Now, we've been a bit farther and tried to see, OK, during this period, who else made transfers, positive transfers, negative transfers in the world? So the US made positive transfers to the rest of the world. That's what I just explained. OK, what about the other guy? And they made the biggest transfer. That's why they are in dark red here. The biggest transfers, so the biggest losses on your net foreign asset position are in dark red. And the people who gain are in green. And the people who lose are in red, but they don't lose as much. Well, so the white is we don't have data. So you see that the other countries which made transfers during the financial crisis between 2007 and 2009 are Switzerland, which actually made quite a bit compared to its GDP. The euro area, there's some people up there. And the people who actually, China, again, partly because it was linked to the dollar, and there are important exchange rate effects during this period. But also the data here, I'm not fully convinced by the quality. So I'm not going to push China very much. However, the people who tended to gain were India, so some emerging markets, more or less, the BRICS, Canada, and the UK. In the UK, it's interesting. It's due to the financial center position and the fact that there was a lot of very toxic assets on the liability side of the UK balance sheet. So a lot of the liabilities got written off, and this is what explains the UK here. It's partly a financial center effect. So if we look at, besides these numbers, just focus on the first column here. The people who made the transfers are first the US, then the euro, Switzerland, who made large transfers compared to its size, again, and then to some extent China, but again, I wouldn't believe this number too much. So these are the countries which tended to provide the insurance here, and I mean, I have some countries missing from the column, and the countries which tended to benefit are the emerging markets. Now, if you think again about the emerging market structure in terms of balance sheets, you understand why they tend to benefit. And it's because, so they are not long in risky assets. They are not long in equity and FDI. They sell FDI and they sell equity. So in crisis time, well, it's other people who hold their risky liabilities in terms of FDI and equity, and they are invested in relatively safe assets, disproportionately in reserve currencies, in government bonds, etc. So in crisis times, they receive the insurance. Their assets, which are the government bonds, the reserves, etc., maintain their value, while their liabilities go down. Right? So this is what explains why they get insured effectively by the center countries in crisis time. And of course, that means that in normal times, they forego, they have a valuation loss on their net external asset position. They pay the insurance premium to the US in particular. Everything hangs on together. All right, I just have some small anecdotal examples of exposure to toxic assets as far as they can be reconstructed from partial data taken here from Acharya and Schnabel. Who is exposed to ABCP, so asset-backed commercial paper, so let's call that toxic assets during the crisis, and how does it affect the losses on the portfolio debt that these countries have vis-à-vis the US. So you can see that the euro area was very exposed to toxic assets, and indeed the euro area took a large share of the total loss on the debt portfolio. So there's no mystery. Your external exposure and you know, how much you lose reflects also the risk-taking behavior of your financial sector here. Okay, so now I'm going to just so finish this type of overview of the international monetary system by saying that so we have seen this trend of emerging markets accumulating reserves. We've seen the center country providing insurance. It all kind of fits together. There's an excess return for the center country. There's an insurance transfer during the crisis. And we also looked at the effect of accumulation of reserve on the downward trend of real interest rate. Okay, so now if we try to, it's difficult, but if we try to look forward a bit, if the trend, this kind of current structure, keeps being the structure going forward. It's a big if, because lots of things can happen, as always in economics. But if emerging markets keep on accumulating a lot of reserves, okay? So then what happens? So the problem is that the weight of the world economy is moving in the sense that emerging markets have, as a trend, have become bigger in the world economy relative to advanced economies, in particular relative to the US. So if the trend goes on, so we have a growing demand of safe assets from the US in particular by a growing part of the world. And we have already these very low real interest rates. So we have this supply of safe assets, government bonds in particular in the US, which grows at a given rate and is backed by the US fiscal capacity. Okay, it's safe as long as the US is reasonably safe from a fiscal point of view, or looks like the safest country from a fiscal point of view. But if you have a growing demand for these safe assets from countries which become a very large part of the world, then it seems like if we extrapolate a bit, we have excess demand compared to a supply which is not growing as fast. Yes? That's, of course, if we extrapolate. As I said, a lot of things could change. Now, this, for an international finance point of view, this brings back an old problem that we had in the 60s, which was called the problem of Triffin, from Robert Triffin, who was a Belgian economist, and it was called the Triffin dilemma. Triffin pointed out that in a world under Bretton Woods, where there was a fixed stock of gold, more or less, held by the United States, where the dollar was convertible to gold at a fixed rate, okay, that was the world, and you had a growing demand for dollars abroad, because the world was growing a lot, so you had a lot of people who were asking for dollars. Well, the more people were accumulating dollars, all these dollars were supposedly could supposedly be exchanged against gold at a fixed rate. Well, it couldn't work. You have a fixed stock of gold, fixed rate with the dollar, more and more people accumulating dollar. At some point, there are too many dollars for the stock of gold, right? Seems logical. And so he pointed out that in a world like that, the more the dollar was successful, the more people were accumulating dollar abroad, well, the more it undermined the credibility of the dollar, because it had to be that at some point the dollar could not be converted into gold at the given rate. So the dollar would have to be depreciated compared to gold at some point. That was the Triffin dilemma. The more successful the international currency role, the liquidity accumulation, the more the dollar was likely to lose its value. Well, in some sense, we have a similar issue here. If the world grows a lot, the emerging markets world grows a lot, they want a lot of safe assets, government bonds, US government bonds. These US government bonds are backed by US fiscal capacity. The US fiscal capacity doesn't grow that much. At some point, same thing happens. There is a problem of credibility for the dollar. That's maybe, science fiction, but this is something worth thinking about. And if we look at projections, which are only projections, of course, and should not be taken that seriously, but if we look at projections in terms of growth from 1870 to 2050 here, you see that China obviously overtakes everyone, India becomes very large, and in that world, the United States shrink, and Europe shrinks. So we are in a world, indeed, where there is a big reshuffling of economic masses, and the type of issues may arise. So in such a world, it is therefore not probably inconceivable that one natural outcome is going to be more multipolarity in the international monetary system, and in particular, in a long time, not now, but a likely candidate for becoming an international currency alongside the dollar would probably be, if everything is stays as we think it does for the moment, the RMB, maybe the euro if the euro survives. Who knows? But multipolarity is likely to be a feature, if we look a few decades ahead, of the international monetary system. So there would be some advantages of that, because if you are worried about the type of Triffin dilemma that I was talking about, well, you dilute that worry because there are more fiscal capacities backing the safe assets, the Chinese fiscal capacity, the Euro fiscal capacity, the Swedish fiscal capacity, and the US fiscal capacity, etc. Now, obviously, if you have different types of assets, what you could have as well are very large portfolio shifts. If there is a fiscal problem with a country, you may have, at that point, very destabilizing portfolio flows, etc. So this is not a world without risk. However, it seems that given the current economic trends, if we think about reforming the international monetary system, we have to think in terms of more multipolarity. So we have to think in terms of developing alternatives to US treasuries. That means a lot of work in China, because there's a lot of restrictions and financial markets are very underdeveloped, etc., etc. So that's way, 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 ahead of us. That's not tomorrow by any means. That requires a lot of work in China. That would mean making the European bond market a lot more integrated and a lot, at least bits of it, making it like the US Treasury bills that would require mutually guaranteed European bonds or tranche of European bonds guaranteed. Introducing more stability to such a system would require also probably making these bilateral swap agreements that I showed you a little bit more permanent and being a bit more rational. Actually, it's being done right now. So what we wished for a few months ago is becoming, to some extent, reality here. And then that requires, again, giving more resources to the IMF, which is very small in world markets still. And we could even go farther and making the IMF even more central for the pooling of reserves, etc. So all these type of reforms, I believe, would greatly strengthen the stability of the international monetary system if one believes the type of analysis that I presented to you. And I think I will stop here.